right. How's everyone doing? Good afternoon. It's Tuesday around 5 p.m. Eastern time. I thought I'd share some thoughts on Buffett, thoughts on the market. I'm going to share some ideas that I put in Buffett category investing as well in the small cap area where we've been poking around. Talk a bit more about some of the news headlines. There's really a lot to go through here. I have a thesis on the bifurcated market. There's been a lot of talk about 5-year money coming due. And I'm going to talk about that as well and highlight how even in public markets, there are firms that have a lot of debt issues. I'll highlight a few and show you how you can go find them and avoid them. So a lot to get into today. Make sure to keep questions coming as I go through this. First off, hope you're all well. We had a good weekend here. I took my kids out to the local library. And we flew a kite actually the day before too. It was fun, just introducing my kids to like kite fly. And I realized that anything that's fun for kids becomes fun for you as a parent again. It's just a big circle. Just the joy of having those experiences holding a kite is a lot of fun. Go get a kite on Amazon before the price goes up 145%. Enjoy a kite, go to a park, fly it. One other, by the way, announcement. If you're in New York next Tuesday and you're an accredited investor, give me a holler. I'm hosting a dinner with my friend Oliver Wright. Oliver is the head of Olivian investment management firm. He was previously the CEO of CIFC Asset Manager, which is a large CLO issuer, publicly traded. Known Oliver for 10 years. We're hosting a breakfast and a lunch at a nice private restaurant. So we've never done this before. It should be fun. Talk about some content, talk about AI, share some of the tech we're building. But shoot an email to mark@lumida.com. That's MARC@lumida.com. I'll post it here if you want to join. We don't have a lot of seats, so try to see if you can get in there while you can. So let's get into it. So much to get through here. Like first off, Buffett's news about stepping down as chair of Berkshire Hathaway and handing the reins to Greg Abel. What a moment. Really is a changing of the guard, right? Buffett was one of the leaders in building community. It's a pilgrimage to go to Berkshire Hathaway and visit in Omaha, and you see all the various vendors and companies he's invested in offering those kinds of products. It really is a community, and he was the first investment influencer, right? We take that for granted. I mean, maybe he's not on social media, but he really was the first investment influencer voice, and he built it around community and regular content through his annual letters. So it's a bit sad to see him go. It's incredible that, he's in 94 and he's still very bright, cogent, and conducts himself with a lot of wisdom, clarity, humility, and humor, right? He announced in the very last minute that he'd be stepping down as CEO, as if that'd be the least important agenda topic. And they took a 10-minute standing ovation for him. And at the end, he said, look, I see you're all clapping here, and you're really happy to see me go. So, just great to see his characteristic humor and wisdom. He had some quotes around tariffs. If we have time, we can get to those. I know I've been talking about tariffs a lot, but there's a lot of other content I want to talk about here as well. But I just want to pay my respects to Warren Buffett. And to that end, I'll share ideas that I call quality compounders. I don't think you can really apply Buffett strategies in large cap anymore. They're too expensive, right? Costco's 50 times forward earnings. Walmart is 35 times forward earnings. These are expensive businesses. Berkshire Hathaway itself is more expensive than the S&P on a multiple basis. If you look at Berkshire from a price to book value, it's 2 times. That's a business Buffett himself would not buy. It's too expensive. But the cult of Buffett has created a premium in Berkshire Hathaway, and his departure has caused the stock to sell off. So, if you buy Berkshire, you're owning a bunch of T-bills, you're owning a bunch of cash, and you're paying twice the price for at least that component of the portfolio. It doesn't really make sense to own Berkshire Hathaway here. But there are lessons that you can apply from Buffett and identify opportunities that are out there in the market that I think are interesting and actually good ideas in today's environment. So we'll spend some time on that. So let's see. One idea I want to share with you is this idea of 5-year money coming due. And this is an idea that really Jem Karsten, Croissant on Twitter, advanced. And I do think it has merit to it, although not in large cap land. The basic idea is that 5 years ago, funding was cheap, interest rates were low, you could borrow, and now that money's coming due, right? So if you took out a loan in commercial real estate, obviously that sector has been a lot of pain. There's $4 trillion of CRE debt that's going through different kind of workouts that's impacted the construction category. But in public markets, you can see it as well. I mean, there are companies out there that don't have enough cash or free cash flow from operations to service even their short-term debt. And they're rallying, which is kind of wild. I'll show you an example of that. And there are like 70 to 120 of these I'm just doing some quick screens on this stuff just to get a sense of what's out there. But, and the reason I highlight that as well is, Buffett, he always focused on the balance sheet. He would spend more time in the balance sheet rather than the income statement. Most people do the exact opposite because it's harder to disguise issues on the balance sheet. You can see inventory build up. You can see accruals in the form of receivables building up, but not cash building up. If you're playing games with your accounting, for example, you can see whether your working capital is building or is declining and freeing up cash flow. You can see whether you have balance sheet issues, and companies that have bad balance sheets and can't meet their debt have significant left tail risk. So, Peter Lynch would talk about this too. It's like study the balance sheet, make sure the balance sheet's good. So, with interest rates higher and the 10-year higher, those companies are under more pressure and more stress. So, on the flip side, there are opportunities out there where if they have access to financing, they can refinance, they can sell assets, they can generate free cash flow because they have a good business model. Then those companies are extremely cheap. Some of those companies, right? They price like call options right now. They're fundamentally good businesses, but they have lots of debt. And the question is, can they meet the debt? So let me show you an example of this. Here's a company. I'll share my screen. This company just looks like a whole world of awful. I have no position in this, by the way. I'm just sharing a different way to think about a business. I know we'll get into some of the ideas I like out there, but this is a company called VinFast Auto. It's a $8.6 billion market cap. That's not nothing. That's a real business. All right. This business is in the design and manufacture of electric EVs, e-scooters in Vietnam, Canada, and the United States. So they've got some tariff exposure too. You can see they don't make money, so there's no PE ratio. So if you take a look at this company's balance sheet, I'm going to jump to the balance sheet section here. You can see they've got about 130 million cash on hand. And if I jump to the liabilities, I can see they've got $9.8 billion in long-term debt. Now the market cap is 8.6 billion. So this is a levered firm. You can have leverage as a firm so long as you can service the debt. Now, if you look at their current liabilities, it's around $6.7 billion. Okay, so you can pay off debt with cash flow or financing, right? You either raise money by raising equity, issue shares, or you issue debt, or you generate money through free cash flow. That's the only way you can pay off debt, right? Or you buy back the debt at a lower price. They're not doing that. So if you take a look at their cash flow from operations, it's negative $1 billion. This is an EV firm. EV is not that hot, not that exciting. Look at Tesla. EV demand is down, and Inflation Reduction Act is going the wrong way from the perspective of EVs, right? And they're spending money. They're investing in $628 million in CapEx. So this is a good example. Now, this company has been issuing debt 1.9 billion. They're going to attempt to use this to refinance. But when they issued that debt, it's at a higher interest rate because interest rates are a lot higher when they first took out financing several years ago. And the net of all this, if you add up their cash flow from operations or cash flow from financing or their cash flow from investing, they've got negative $1.9 billion in free cash flow. And they got to pay $6 billion in debt. It's an $8 billion market cap company. Okay, it makes no sense. This company, I would expect, let's check it out in 6 months' time, okay? Add it on the calendar. I would expect this company is going to be worth a lot less in 6 months' time. I created a basic screen, actually, just to look for these businesses. So it's not hard to do. You can find that there's a number of these businesses out there. So these businesses are concentrated in the small cap category, in the IWM category. IWM is one of the indices, like the Russell small cap category. Now, I really don't see it in large cap, right? And that makes sense, right? If you're a large publicly traded company, you have more wherewithal. If you've got a large market cap, you can issue shares. JP Morgan's willing to give you a corporate loan. You can refinance. You have more assets because you have a bigger balance sheet. So the issue is really on what Besson calls Main Street. Main Street has issues right now. And what you see in the public markets, you're also seeing reflected in the private markets, especially around commercial real estate areas, right? That issue is still a lingering set of issues, right? So they meaning the administration, they do need to get the 10-year down. I mean, the 10-year tightened today, bonds got bid up today, but it's at 4.3%. And it's been moving the wrong way relative to risk assets. They're not providing diversification as they used to. So, if you're introducing tariff policies that increase your cost of goods sold, that hits your margins, like a company like that, this is an EV company with operations in Vietnam and Canada, the United States, you're going to have a world of issues to deal with. I'll show you one other quick example, by the way. Traeger Grill. Traeger Grill, they import internationally. I'm not sure where they source their product from. Maybe China, maybe Vietnam. That's not so much the point. But Cook is the ticker. Okay. This stock used to be the American dream for some business and some founder. Take a look. 187 million market cap, totally destroyed because their cost of goods sold is going to go up a lot. And this is a popular new grill. I love to grill, so I took a special interest in the stock. I'm looking forward to grilling season right now. You want to stop by? We'll do some grill, okay? So, but that business is just under a lot of pressure, and then you've got consumer confidence pulling back. So that's called a durable good, right? They report that as a durable good. There's less interest in these large ticket durable goods. So that business is getting hammered, right? This bifurcated market. That's what you're seeing right now. Kind of the haves and the have-nots. Have-nots those are examples of that. High debt, high leverage, tariff exposed, consumer exposed names, although it depends on what segment of the market you're exposed to consumer. For example, lending to consumers might actually work. Funny enough, we'll come back to that later. And then you have things like insurance stocks, which are doing great because they're not exposed to tariffs and mandatory spending. And that's a category I like. It's a category Buffett likes. I'll show you some examples of that too. It's a bifurcated market. So before I get into some of those ideas, I have 3 or 4 ideas for you all. I like them all. I own them all too. So you'll recognize at least one of them. The other ones you probably will not because they're boring insurance companies. They're overlooked, they're ignored, but they're compounding book value, which is what Buffett looks for. So in honor of Buffett, we're going to focus on those companies. And I like that it's a good idea in general, right? So this is a fantastic question. Like, I think you need to be mentally flexible, number one. The market itself doesn't know the direction the market's going to go in right now, okay? The market is processing news flow. And, I wrote in our weekend newsletter that I'll share that here, that that you should expect a sell-off early part of the week. We're getting that now. And this is every now and then you get an obvious setup for risk off, and this is one of them. But I'm actually getting less bearish, and I'll tell you why in a second. So, what we saw going into this week is a lot of, technically just a lot of stocks were well above their 20-day moving averages. And you see that all together in unison across every theme and every index, you're going to get a pullback because people look at a chart and they say, yeah, I'm not going to buy there. So that bid just falls away. So that's one. The second thing, you have an FOMC meeting. The FOMC is not going to say we're going to cut rates despite the pressure from Trump, because the hard data hasn't softened. You just had a strong non-farm payroll print that exceeded expectations. Last month exceeded expectations. So you don't have confirming evidence to cut rates. You have soft data, which shows all sorts of post-traumatic stress disorder. The soft data is consistent with levels you see in a recession. But the primary marker of recession is job losses. We don't have that yet. We don't have job losses. You see federal layoffs, but even that is abating. On initial jobless claims, they were slightly elevated last Thursday on both initial and continuing. But one shouldn't overreact to one data point there, right? You are seeing cargo ships that are showing up to the port empty, and you're going to see more of those issues play out. You've got 8 million people employed in supply chain logistics transportation, truckers, for example, that vote predominantly Trump, by the way, right? The longshoremen will do fine, they're unionized, right? But you're going to see issues in that category, but markets can look through that if they see a path to rational trade deals. Keyword is rational. It's not just about getting a deal. You got to get a rational deal, which means a low and effective tariff rate. Bonus points if you open up a new market. Okay, we saw Trump meet with Carney today, Canada's PM. The tone was collegial. Trump said, we don't want your cars, but the tone was collegial. And Carney engaged with Trump in the right way. It couldn't have put it better. There's a style that matters. So, the end policy rate fundamentally is what this whole thing turns on. No one knows that. So markets are trading on technicals and positioning, and you have earnings season, you have buybacks, right? The blackout period, which prohibits companies from buying back their own stock, is largely over. And you get $1 trillion in buybacks. Plus, this year, buybacks are a bid. So owning companies that have buybacks is a good idea. There's a bid there, and markets have low liquidity. Why not own firms that buy? They're good companies that have buybacks. They have free cash flow. It's a good combination. So tomorrow, there's reporting that we will get a view into the tariffs on semiconductors. Now, any tariff above zero is just not good if you want to advance AI dominance of the United States, which is perhaps the most singular important objective for the United States to maintain leadership in, because AI is this kind of singularity event, like around the event horizon of a black hole. It's hard to make predictions about how we organize production, supply chains, consumer behavior, human life with the rise of AI, with intelligence in the palm of your hand, which ultimately manifests in driverless cars and robots, right? It's hard to make those predictions. What do small, lean organizations look like with AI? What's the pace and velocity of disruption? We're talking about call center disruption now. Think about broad scale industry disruption. So you got to win the race for AI. So the optimal rate is 0, okay? But from a policy perspective. However, it's not likely to be that case. We'll see what that number is tomorrow. I think if the number is above 10%, the markets would sell off. This is news headline risk. It's unfortunate we have to deal with it. But I think 10% is where markets are anchoring, just due to comments that have been made by Lutnick here and there. You kind of read between the tea leaves. The other side of this, though, is the Mag 7 companies, Meta, Google, Apple, Tesla, they all spend money, it's called CapEx, on these GPUs, and they spend a ton. So if you see tariffs on these semiconductors, that'll impact the earnings of the Mag 7 names, except for NVIDIA. They'll be Well, NVIDIA will get less demand. Theoretically, it's supposed to get less demand. If you put a tax on something, you get less of it, right? Microsoft has a constraint. They have a CapEx budget constraint. They're modeling to a budget. They're modeling to an ROE number. And their CFOs are very, very good at this. They pull levers to hit numbers and hit earnings per share. Okay. So that's a key thing to watch for. I think investors sold the risk ahead of Wednesday FOMC and that kind of headline. But at the same time, the admin has David Sachs, who understands the AI game. I'm sure he's telling them, hey, don't blow it. That's one. Two is you've seen cheerleading from kind of everyone in the administration. The messaging isn't consistent, but they are trying to cheerlead markets. That includes Lutnick yesterday at the Milken Institute. He gave a very short speech. It was kind of a fourth grade speech, actually, to a very sophisticated audience. You can read the transcript from the Treasury website. It says, look, the United States has come back from every kind of war, pestilence, or famine. Not his words, my words, but it's true. The Great Depression lasted a long time, though, and it was longer and deeper because the policymakers, the U.S. government, fumbled the response with the Fed withdrawing liquidity and allowing bank failures to accelerate, number one, and Smoot-Hawley tariffs. So you can't say, hey, the U.S. always comes back, ipso facto, we're going to come back no matter what. No, policy matters. If you look at most country equity markets throughout time in history, the United States is really the exception to the rule. You have equity markets just kind of go nowhere for 20 years, like Japan or Turkey's got a mess right now, or Argentina is in a mess or has been in a mess. They go in a mess, they get out of a mess. Everyone lives in Argentina as a global macro investor, apparently. They have money in Uruguay, they have dollars there that go back and forth, right? So, they're cheerleading. The point is they're cheerleading. They're not trying to talk down equity markets. And in a thinly bid market, dominated now by retail investors, that can have some impact, right? Here's another dynamic, and I wrote about this in the ledger. This is a really funny dynamic here. Funny, strange, funny, odd, not funny, haha. But I will, the dynamic we see in the market is this. It's a technical dynamic. And what you see is hedge funds have a gross long exposure that are at 5-year highs in terms of their percentile exposure. What does that mean? It means their long exposures is essentially maxed out. Like they've got a full plate of stuff they want to own, but their net exposure is very low. It's around 9th percentile over the last 5 years. And the reason why is they've shorted a lot of stuff. And they've done it primarily through like macro products like ETFs and futures, especially names on small caps, okay? So the net exposure is low. They have a bunch of stuff they own long, but they're shorting a bunch of stuff here, okay? And markets have run up materially in the last 2 weeks. And that can force hedge funds to get into a performance chase where they've got to cover to not lag a benchmark that's rallying. Even if a hedge fund has a low net exposure, you can say, hey, they're not benchmarked to the S&P. No, you're benchmarked to the S&P in some way, right? Or you can park in T-bills. If you're saying your net exposure is 0%, then you got to beat the risk-free rate. Why not get private credit? So that is a consideration out there, that's a consideration out there. What's a good way to look at the Russell? Let me see, without all my lines and charts. So it's possible that you can get a hedge fund short squeeze. In fact, isn't that what's happening today with like certain stocks out there, like HIMS, I would argue, right? You're seeing some short squeeze phenomena out there. And hedge funds are like marginal price setters too. So it's retail investors versus hedge funds, a really funny dynamic. And right now, retail investors are winning, okay, because of the cheerleading from the administration. It's an interesting dynamic. There's been some cool off the last 2 days, but if we get solid news on these tariffs tomorrow in terms of the policy, I think you could actually rally more, given the backdrop I shared earlier. And if you look at Q4 2018, which was trade war 1.0, now those are smaller, more limited trade war. It's just around China, so much more narrow scope. This is far broader, far more impactful, right? But coming out of that, you had a rally that went overbought, stayed overbought. And what I'm noticing today, and even last Thursday, for example, or last Wednesday morning, when there was some bad macro data, you had some elevated inflation. The VIX, which is a fear measure, spiked, and bonds got bid. So there's still a lot of fear in the market. There's not complacency, which is good. That's good. So you can get a rally because of that. On Friday, the VIX melted like 5, 6, 7% on one day. And here you are, Monday and Tuesday are down, right? Complacency started to creep into the market because you had this strong Friday non-farm payrolls report with job creation. So people had a sigh of relief. They bought a bunch of stock, markets gapped up. And that was kind of the peak sentiment around that. So I'm seeing fear whenever markets drop even a little bit right now. As long as we see that, I think you should be constructive, just technically. And then the intermediate term view turns on policy. Where do these policy rates land? And the question on how that plays out, because I don't think the admin even knows yet. They're different factions. Lutnick has said that, by the way. Lutnick has said they're different factions. Okay. I believe Trump is like the Energizer Bunny. When the battery's fully loaded, when stock prices are high, and he'll be aggressive on tariffs. When the battery is low, stock prices are low, he will capitulate on tariffs like he did with China 2 weeks ago. Because I do believe he thinks these tariffs are good policies. They're not, but I believe he thinks they are. So he has more, he will lean into that instinct when markets are favorable. And when they're not, then he'll pull Navarro off of CNBC and put Besant in front of them. Okay. And Besant right now is getting more time on major media, which is good. Okay. That was a long discussion there on markets. Yeah, it is a weird market. It's like you gotta, look, trends are working, momentum's working again, by the way. Momentum had 2 terrible months. I like momentum factor. It works over long periods of time statistically. There's a reason why Renaissance, Citadel own momentum factor. It works. It is working again. I have a momentum basket that I track. It was down like 10 basis points today. Beat the market today. It beat the market yesterday. So my view is if you find a good asset at a good price, and I'll share some of those, I think you should go get it. Again, you got a lot of headline risk, so it complicates things. If you're very sophisticated and you can find businesses that are going to blow up because of bad balance sheets, maybe you do some homework, research them, short them. That can be hard too, though, because I gave you an example. Here's a business, this EV company with tariff exposure, sales and operations in Vietnam and Canada with a boatload of debt, but it's rallying, right? It's rallying because of these, it's rallying because the IWM is rallying. Hedge funds will go buy the IWM, and that creates a bid for these other things. So I think the Fed, they're going to restate what they've been saying the last few weeks. They're not going to cut. They'll say tariffs came in higher than they thought in terms of the policy guidance, but they stand ready to cut rates if there is labor market weakness, and they'll do that. But it won't happen in May. Markets don't expect that in May. Markets don't expect that in June now either. If you see a big miss on the non-farm payrolls report for the first Friday of June, which would be May's report, then they'll cut. That's what'll happen. So thank you. I try to get to the point. I appreciate it. So, okay, let's move on here. We covered a lot of ground there. Let me share some ideas with you. Okay, this is in honor of Buffett. Let's do some Buffett stuff. What does Buffett like? He likes insurance stocks. He likes banks. He likes consumer staples. He likes quality compounders. He likes value. He likes free cash flow. He likes buybacks. So let's start with insurance. Okay. Here's a business. I wrote about this on Twitter briefly. I didn't really lay out my kind of argument for the name though. This business it's called Renaissance Reinsurance Holdings. Renaissance RE Holdings provide reinsurance and insurance products in the United States. It's a $12 billion market cap company. It's got value. Okay. Decent multiple there, about 7.6 times. And they're in property and casualty, property reinsurance. So the thing about Buffett is the reason why he studies the balance sheet, because what he's looking for are companies that compound book value, right? The modern investor looks at revenue growth, earnings growth. His approach is look at, do I have a business that can compound book value? Okay, what does that mean? What does book value mean? Okay, you have a balance sheet. The balance sheet represents the accounting value of the company, not the market value of the company. Remember the old story about Mr. Market knocks on your door and gives you a price for an asset you own. Sometimes it's high, sometimes it's low. Buffett's anchored around book value and his own sense of intrinsic value. So that's what he's focused on. And book value grows and compounds when you generate free cash flow through your operating activities. And if you can reinvest and grow, and therefore grow at a faster rate in the future, fantastic. So the book value of a balance sheet represents the property, plant, and equipment. So if you're a restaurant, it would represent the property, plant, and equipment, like the franchises that you have. If you're FedEx or logistics business, it's all that infrastructure as you grow and compound, right? In Apple, it's the know-how and your distribution and the Apple stores. That's book value. Compounding that book value is the idea. If you're a bank, it's really easy to understand. Banks and insurance companies, Buffett really loves, because those businesses are just balance sheets. They're phenomenal, very super interesting business. Think about it. What's compounding if you're Renaissance or they have no franchise? The balance sheet itself is compounding. The same thing with the bank. You make a loan, you get paid back for the loan, generate net interest income. Now your balance sheet's bigger. Guess what? You can make more loans tomorrow and you compound and grow like a snowball. That's the idea of compounding. That's the Buffett insight. He's like, hey, I want to own a business where I can close my eyes, ignore the market, wake up 15 years, and I've compounded wealth. So the main thing Buffett focuses on is book value per share and that compounding. I'm simplifying a bit. He looks at a lot of other things. Okay. I have another video that actually spends like an hour going through Buffett, but I can post that later. So let's take a look at Renaissance RE. So this business has a lot of free cash flow relative to market cap, 30%. I like that stat. The price to free cash flow is 3.3 times. I like that stat too. Price to book value is 1.3. It's not bad, I guess. And they're buying back 9% of their stock. I like that too. That's a bid. The return on equity is 14%. So this measures how fast they can reinvest in their business. The higher, the better. Buffett likes 20%, actually. That's kind of his, the faster you can reinvest in your company, the faster you can grow and compound, right? That's like it's like your afterburner, so to speak, if that makes sense, or there's got to be a better way to explain it. It's like the slope of the hill you're going down, in a way. If you have a high ROE, you can reinvest more quickly, right? So they don't have significant debt issues either. I'm going to show you my AI tool real quick here. So talk about this now and then. It's a pretty capable instrument. This is a real-time Twitter newsfeed here that's curated by my LLM. It's awesome. But anyway, let's go to Renaissance RE. So I can type in the ticker here. And this is going to give me a quick synopsis, the story for this business. And you can see that, they're growing their book value 26% year over year. So That's how Buffett would think. You say, hey, they're growing their book value 26%. All things being equal, gee, this thing should be worth 26% because that's real growth in the balance sheet. Those are marketable assets, the balance sheet. They're investment assets, which they can sell, presumably, if they're liquid. Most of them should be. They have buybacks. Our strategy of repurchasing shares reflects our unwavering commitment to shareholder value, even amidst volatility. That's an excerpt from the transcript. Transcripts matter because they give you a perspective in terms of how management thinks and are they shareholder friendly. The return on common equity, 29%, that's strong. So this thing is set up for good growth. The market needs to start appreciating it. It's done well the last 3 days. That's good, but it's a start. So they've done some M&A transactions. I won't walk you through all that, but let's go take a look at our charting tool, by the way. This is pretty cool. It's our in-house charting tool. Oh, this is work in progress. We're always iterating on it. By the way, if you want to get on our wait list for this, promo plug, just go to lumidaai.com and you can get on a wait list here, but it's pretty cool. So this is our charting tool, and it's meant for pros, by the way. It's not, we'll make it simple later, but yeah, we got it right around here. This green bar, I made a little line there. That's good. One thing I noticed, by the way, if those of you guys are kind of more technical, is this line is like represents a trend from these peaks. So technically this has now done a breakout. That's a good sign. Doesn't guarantee anything, but it's a good sign, right? So anyway, that's a Buffett idea. Here's another one. Chili's. Have you guys been to Chili's lately? I haven't been to Chili's in like 10 years. Like the Mexican food, it's great. I've always had fun at Chili's. Who hasn't had fun at Chili's? I used to go to the one at 200 Vesey Street across American Express in Lower Manhattan. Fun, family friendly, right? I got to go to Chili's, do some on-site due diligence here. There's one like 15 minutes from where I live. I bought Chili's yesterday. Eat. Ticker EAT. This is Chili's. This business, this is a classic ROM stock too, actually. This is a ROM stock too. It's a Buffett and a ROM stock and a Peter Lynch stock, actually. More Peter Lynch than Buffett, actually, because it's a restaurant. But Buffett's own restaurants, he owned McDonald's back in the day, right? So this has 133% return in the last year. That means it has momentum. Okay. And then the valuation is in the mid-teens. So it has value. It's not a lot of value, but it's got value. It's a lot cheaper than Cava. It's a lot cheaper than Chipotle Mexican Grill, right? Cava's up 26% in a year. Remember, this thing used to be nuts. I made fun of these stocks for a long time. These guys are in bear markets, right? Chipotle, this is Bill Ackman's Chipotle Mexican Grill. This stuff is in a bear market, down 21%. And it's still expensive, right? 40 times earnings, 44 trailing. It's too expensive. Valuation catches up. At some point, it catches up. The bear case for EAT is that the theme, its peer group, is in a bear market. So you have to bet that it bucks the trend because that factor is going to weigh on it somewhat. At the same time, though, if you're a long-term investor, they can compound and grow. Well, that's kind of interesting. So let me show you some stats again from our AI tool. I'm going to share my screen again. So, I mean, this is how AI transforms investing, right? I mean, and it would take a long time for an analyst to generate this report. It's a very thoughtful report with no comma misplaced, with the right perspective. We had to tune this model and train it. It's not something you go ask GPT. It doesn't work like that. But anyway, revenue's up 14% year over year. That's great. It's beating inflation by a lot. That's great. I want to see that. I like businesses that can at least have revenue that beats inflation. Their margins grew in a backdrop where you have some inflationary pressures. That's good. Same store sales growth. This is the big one. 31%. Same store sales growth. That's big. They had a turnaround. It's working. We're winning market share because we're more top of mind. I wonder if that relates to immigration anyway. Does that relate to me? Is there a Hispanic bet here? I was at a VC conference last week. My friend Oliver, I mentioned earlier, he hosted, and there's a company building a beverage, an energy beverage, like a Monster, folks in that population. Maybe, I don't know. Do Hispanics go to Chili's, or do Italians eat pizza? I guess who doesn't eat pizza? I don't know. We just go to Chili's and check it out, right? So here's their peer group. And these are restaurants. Restaurants actually are quality compounders if they can grow, if they can open new franchise. If you invest in a new restaurant and the same store sales growth is positive, and you get a payback within 1 to 2 years, and you can keep doing that again and again and again, that is a compounder. As long as your brand isn't fickle. Like Chick-fil-A, how do I invest in Chick-fil-A? Show me Chick-fil-A, show me Trader Joe's, get me into Jersey Subs, which Blackstone bought. Blackstone knows what they're doing. That's a quality compounder. They're going to reinvest the cash flow in CapEx and new franchises. And they know their unit economics. They know each store makes money. You get same store sales growth. And that's it. That's what Buffett investing is all about, by the way. That's what it's all about. Most of Twitter investing is buy high, sell higher, which isn't necessarily bad, actually. It's complicated. I don't know. It's a long topic. Maybe we can touch on that. Like an investment in these uranium names. I shared one earlier. That's a different story. It's a growth story, right? Betting on the future story. Different way to think about things. So this is Chili's, ticker EAT. The other thing I love to do is you got to look at the transcripts of these companies to really understand what's happening, because management's bound by law to make faithful representation. Doesn't mean they always will. They usually do. Most management is honest. Make sure there's no turnover in the CFO department. So this tool actually, it'll go through the transcripts and highlight green, yellow, red, so we can focus, and process more information quickly. And so it does a transcript analysis. It gets the key metrics. And yeah, they have we're looking at key stats here. The year-over-year traffic grew 20%, driven by product offering and operational improvements. One of their executives said, quote, "When you have traffic trends like ours, it's really coming from all places. New guests are coming back and current guests are returning more frequently." So, there's some Q&A here. But that's a good way to look at things, right? It's not enough to just look at a chart. That matters too, though. That matters too. It all matters. So the other thing that matters is, how about the peer group? Because if you got another asset in the category that is priced better and growing quickly, then that other asset, not in your field of view, can weigh upon the performance of this asset. So I'm going to share my screen again too. I'm going to share, I have a theme called restaurants here. I'm going to hit go. This is Wings, Chipotle, Shake Shack. And now I can comp them, right? So if you want to do your homework, you should look at all of these, really. Okay, we don't have time to do that now. We owned Shake Shack early last year, for those that you might remember. I don't know. I think EAT's better, and it's above the 200-day moving average, which is relevant, right? So, what else? We have questions here. And keep going. Here's another one. Okay, this is an interesting idea. This is also a restaurant. I've been bearish restaurants for a long time, right? Go back, look up restaurants in my feed on Twitter. In May, I was like, hey, restaurants are going to enter a bear market. Stay away. Here's an interesting idea. It's small cap value. It's going to have a lot more volatility. The value's there. The chart looks absolutely horrible. The funny thing about charts is that sometimes they can get so dislocated and so hated, they can be interesting. This is a mean reversion idea, not a momentum idea. The two opposite forces in markets, momentum and mean reversion. Momentum is the cool kids. Mean reversion are the ugly ducklings that they're so cheap that you get a sprinkle of good news, and there's so much priced in, there's no one left to sell, then it can go up, right? That was like Bitcoin after SBF got locked away, for example, right? Or JP Morgan during the banking crisis. All these banks were cheap then. This is an interesting one. Loco. This is small cap. Look, it's going to have less liquidity, therefore it has more risk. Do your own homework. 270 million market cap. But have you guys seen Breaking Bad? I think one of the greatest acts of human creative achievement ever. It's such an incredible series. I mean, Breaking Bad is so good. So there's this character in Breaking Bad named Gus Fring. Remember Gus Fring? You can't make this up. I found a publicly traded comp to Gus Fring's. He called it like El Pollo or something, right? Chicken. Okay, this is Gus Fring. What a great character. Have you guys seen this thing? It's so good. I look forward to the day when I can watch Breaking Bad again with my kids. They're too young right now. I mean, it is a work of art. Like when Hank went to the desert, and I won't give away what happens in the desert. You probably will have seen it. I mean, that I had a tear in my eye. That was a sad moment for me when Hank went to the desert. That was a sad day. Felt like I lost someone. Okay, so Loco, check out Loco. El Pollo Loco Holdings. Gus Fring. Gus Fring's restaurant's called Los Pollos Hermanos, the Chicken Brothers. Los Pollos Hermanos. And then this one's called El Pollo Loco Holdings, okay? It's chicken. Okay. This chart's terrible. Look at this thing. It's been destroyed. It's like $14. Now it's like $9. Okay. Bought it 2 days ago right here. Okay. Let me tell you about this business now. Interesting business. It's a restaurant. They're shifting from a company owned and operated model to a franchise model. That means less CapEx. One of the primary owners is this company called Big Laurie Capital Corp. They own 13% of the business. They've been buying stock in the public market. And they made a non-disclosed offer to acquire the business. So there's a bid. We know that they have to make a higher price than the traded market price. We don't know how much higher. It's a private equity company. What are the private equity company going to do? They're going to add capital and compound, just like Buffett. Add capital and compound, or like Blackstone in Jersey, Mike's Jersey Subs. That company Blackstone invested in. That's what they're going to do. Now, valuation is good. 10 times. Free cash flow is good. They're not growing that much. This is a value stock. Value stocks don't grow as much. If you add capital, you can grow. Or if they can reinvest operations, they can grow, right? So they have buybacks. Instead of investing in growth, they're investing in buying back their own stock, which is kind of interesting, right? Why wouldn't you just invest in growth? If you have a quality compounder and the formula is working, you're supposed to invest in growth. You're not supposed to buy back your stock. You're supposed to open up new places. And the reason they're not is because they have a shift to a franchise model. So it's CapEx light. So that's really a marketing story now. It's not a build out and an operational story. So that should improve the ROE. ROE is not bad. Again, I'd like to see higher, but again, you're buying it cheap versus other assets in the marketplace. From a valuation perspective, let's take a look at how this thing has priced over the last 10 years. You can see this is at 10-year valuation lows, right? The last time it was this cheap was October 26, 2023, which was the bottom of the 2023 correction. It's never been this cheap in terms of the multiple ever. So I said, okay, I'm going to hold my nose and buy that. Right? Seems to make sense to me. It's cheap. Is that multiple going to go lower? It could. Anything's possible. Is it going to go higher? I think it probably goes higher. I think it goes to 12. Better odds than it goes to like 9 times. So my reward to risk is asymmetric here. And you have the catalyst of that shareholder. Anyway, these are interesting ideas, right? It's a It's a quality compounder. They're doing buybacks instead of compounding, though. The PE company is going to tell them to stop doing buybacks and just they're going to compound. They're going to open stores or invest in marketing. So that's what I'm doing with that one, right? It's an interesting idea. It's a different way to think about an opportunity. I doubt anyone on Twitter is talking about that one, right? No one's talking about El Pollo Loco, which I like also because it's under-owned, right? So covered a bunch of stuff. I'll show you one other. This name is so illiquid, I can't even buy it. But I'll show you an example. I've been talking about like small cap value. I think in small cap land, as I mentioned earlier, it's a bifurcated market where you have balance sheets that have too much debt and they're going to live and die with their free cash flow. And can they sell assets to them? But others, which are just very cheap. Here's one. I should have done this podcast on Friday because it's run up in the last few days. Oh, pull back a little bit. All right. This is Gary. I'm not saying buy this, by the way. I'm not. Just do your own homework. But I was looking at recently, again, terrible downtrends been destroyed. But now they look kind of interesting where it's like 1.2 times earnings. And their price free cash flow is like 0.7. And their free cash flow market cap is 143%. They're paying back their debt because they have a boatload of debt. But they are paying back their debt. That's the key thing. They are paying back their debt. So after they pay back their debt, then they can go buy the stock. And this company, what they do is they own a bunch of cable studios, cable television. So they sell ads. This used to be like a John Malone type business. If you remember John Malone, the roll-up king for cable TV. That was like a big deal a couple decades ago, right? But so they're interesting ideas in small cap land is the more general point. And you would want to look at their cash from operations. You want to look at what their current liabilities are on the balance sheet and make sure that they can pay their current liabilities. And it looks like they can. They have 33 million in current liabilities, that they have 135 million in cash, right? Forget about operating. They can pay with cash. Operations matters too, though, for sustainability. But I think these are interesting ideas. I saw a funny stat. It said the best performing theme was small cap international. I said, gee, that makes sense because international makes sense and small cap makes sense. It's like vanilla ice cream and a hot fudge sundae. Put them both together. So if you look at Brazil, for example, Brazil is an interesting combination of both of these. It's already rallied quite a bit though, right? So I would look for, can I get a better entry? And Mexico. These markets are trouncing the United States. Let me share my screen here. You can take a look at Mexico, right? This is international and value and small cap together, right? Kind of makes sense. Mexico up a bit today. It's that'd be interesting entry point when it retests a moving average, and just that's an interesting way to think about it. And then if it breaks that, then sell. From a risk management perspective, that's how I might think about that. But with there's a repatriation of capital, right? People starting to invest more in the home markets because of this tariff trade war idea. So imagine you've got a boatload of money parked in these Mag 7 stocks, which have $1 trillion valuations apiece, and some fraction of that sold, maybe just a couple points. That's hundreds of billions of dollars that are now invested in the opposite of that. The opposite of large cap tech is small cap value. And those are so cheap. So a little capital goes a long way and creates a bid. It's kind of that simple. So I still like the Google, Metas, and Nvidias of the world, by the way. I think they are better than their other Mag 7 names. I think that there's some DOJ risk, antitrust risk around Google and Meta. I don't think this administration is going to break up these companies. I don't see that happening. They're supposed to be more laissez-faire. They're probably just giving them a hard time. We'll see. Los Pollos Armados. What a great series! Such a good show. Such a good show. What else? I think we covered a lot here. Oh, here's another name I bought. Okay, this is a business I've been tracking for a long time. I'm a customer too. It's called, clear. When you go to the airport, if you want to skip the line, you have to have that clear. So I got the TSA pre-check and I got the clear. It's about return on time. We're in the convenience economy. Uber Eats, on demand, everything's on demand. Amazon, same day shipping. Clear is the same thing. Although when you go there now, all the lines are full. Clear is full, TSA is full, the neither the above is full too. But so the things I don't like about this, but I'll tell you what I like about it. I think one is it got to a good valuation, and it's got all these Buffett properties. It's a monopoly. They're the only game in town. Who competes with them? How do you? That's called a moat. It's a quality business with recurring revenue. Yes, international travel's down. Sure, domestic travel's down, but it's a subscription revenue model. Doesn't matter. I'm not going to cancel my Clear membership. Maybe I'll travel less, for example. That's how the consumer is going to think, right? Convenience, one of the best offerings you can have as a business. Convenience matters more than other attributes. People will pay up for that upgrade. They'll pay for service. Convenience. That's why people get the microwave. They get the microwave because it makes chicken in 5 minutes, not because the chicken's great. It's because it's convenient. That's why driverless cars, they're going to offer so much convenience, right? Convenience is a great value proposition. So this business, the price free cash flow is 8.6. So it's a lot cheaper than the PE ratio would suggest. That means they have a depreciation flowing through the P&L, causing the PE ratio. Perhaps that's what it is. Perhaps that's why I'm suggesting. The buyback yield is 11.6%. Okay, I like that. The ROE is 74%. That's high. Now, why is it high? Because how many airports are there to expand into? One day, this will be just a cash flow thing that can't expand more. It'll be a low growth, returns capital, just keeps gobbling up its own stock. It'll become like an equity that transforms into a bond over time, basically, right? So I think it's an interesting idea. I'll tell you something I don't like about it. So I got it 2 days ago, right there, right? This is a little shakeout here, this bar here. And then it got a little bid. So it's funny because others clearly thought the same thing we did and were stalking it like we did. Markets are so reflexive and there's so much liquidity in the system. And, that's an example. I showed you two examples of that. The Renaissance R&R and then Clear, where they get gobbled up quickly. This is a fast moving dynamic market. Is it efficient? That's a different question. That's a complicated question. But, if you see an opportunity, you've got to act on the opportunity quickly. I saw Bitcoin, same thing, by the way. I'll show you this one. This is an interesting one. So, by the way, have you guys seen the dollar just drops? Everything, all these other currencies are going up. Taiwan currency going up. So I'll show you this example here. This is Bitcoin. So Bitcoin at this level, you have to approach almost in a very different way than these other assets. It's not about free cash flow, but right here, it got above these moving averages. Moving averages do play a role, by the way. Don't dismiss them. It's not the end all be all though, but it got over here at this level. It was above these resistances. And that's a buy point right here. It's confirmed there and then boom. Now, what you want to see here is it hangs in there and ideally bounces along these moving averages higher. If it doesn't, then you get out, right? Like what it did back here, for example, is what you want to see. And you get taken out somewhere around here. Ideally, you get into good entry, you ride the wave, then you get out. But it's a different way to approach that kind of asset. It's a very different kind of asset, right? So, and it's more volatile and risky and position size appropriately, right? So do your own research. Any questions? Let's see. What else? I guess, some parting thoughts. I opened, or somewhere in the 15-minute mark, we talked about tariffs, and I think the main thing is they're different factions. They have different views on how to approach tariffs. Trump's the decision maker. I think he sincerely believes they're good. He was on a Meet the Press on Sunday. He said, look, we're getting ripped off. We're losing $5 billion a day to China, and people have to, go without the $30 and buy $3. And it's important to think critically about these issues, because trade improves productivity, it improves income, it improves profits, it improves corporate income and labor income. Capitalism and trade has been the greatest wealth creating force globally. And we're better off when our neighbors are wealthier. We can trade with our neighbors. That's the history of post-World War II. And the United States at the center of it created that trade order, by the way, the WTO and the IMF and the World Bank and the US dollar reserve. It's a rigged game for the United States, you could argue. China should make that claim. Vietnam should make that claim, right? But I'll just break this down for you. And I shared this in the Bips and Bits podcast, but I'll share it again for you. When someone, the US government's not writing a $5 billion check to China every day. Clearly not. There's no treasury. There's no check. There's no wire. So the US government's clearly not getting ripped off. What Navarro and Trump are looking at is the trade deficit. And they're saying, they're looking at that as a P&L. They've literally said, it's like a P&L statement, which is not true. That deficit's created when Apple or Nike imports from a supplier in China, and they're writing them the sum of all that import that Apple and Nike and a lot of small businesses and Costco and Walmart have from China is $5 billion a day. But those private companies are making that decision in a fully informed way. And they're looking at competing alternatives all the time in a competitive market to deliver value and a quality product for a customer at a good price. That's actually what's happening. That's the reality. So, when Trump says they're getting, we are getting ripped off $5 billion a day, who's the we? The we is not the US government. It's also not the US taxpayer. What he's saying is the companies don't know better. And he's saying that we, the US government, know better than all of those companies that made a private voluntary decision to engage in a voluntary transaction. Now, are there legitimate reasons to have a trade wall around China? Yeah, I'm all for that, actually. China's a bad actor. Get the production of Mexico, get the production of Vietnam. I'm all for that, actually. That's a national security concern. They are a rising hegemon. I think they're overrated, actually, as a risk because of China's population. Of all these 45-year-olds and 40-year-olds in China, one child left behind policy, their children are going to the United States and other countries. It's like, 10 years from now, you're going to have a bunch of 50-year-olds there. What are they going to do? You think the parents are going to send their kids to war in Taiwan? Maybe by compulsion initially. We got one child. It's not a stable situation. They've never been to war. So China has a lot of issues, by the way. The government stopped reporting data. We have data. If you go to St. Louis Federal Reserve website, there are hundreds of time series of data. China's pulling all those numbers. One of the data series was what percentage of people are unemployed and what percentage that get unemployment insurance, some metric like that. They're all going up like this. Now, 6 months ago, and they stopped reporting that. Government just censored it. But yeah, China's stealing IP. China's engaged in behavior around Taiwan and just geopolitically and espionage, and hold them to account. All for that. But no one's getting. Show me who the we is in the $5 billion ripped off. It's not the U.S. government. In fact, if Apple has to pay more to move production to India, or Nike's got to pay more, that means less profit margin for Nike. That means less taxes they will pay. And it means less earnings, and that means a lower multiple and a lower market cap. It's a sales tax. That's what it is. It's the largest corporate sales tax in American history. which will get paid by consumers and shareholders. That's what it is. So because Apple sells iPhones to Americans, you create a trade deficit. If you're Apple, you import from a low-cost country with specialized manufacturing and tooling. Then you sell the product you built, the iPhone or the NVIDIA chip, which has a 75% profit margin. Okay, where do you sell it to? You sell it to Americans. Why? Because that's the largest market in the world. By definition, you're going to get a trade deficit. That's not bad. In fact, what do the people in China do? When they get the dollars, they can only do two things. They can either import from the United States, but we're not going to sell them GPUs. We told NVIDIA, don't sell your GPUs anymore. We're not going to sell them F-35 jets. We're not going to sell them Windows software. We'd love to, actually, but China doesn't want to buy that. They've said, we're not going to buy this software. We're outlawing Google, right? So if you can't trade, the only thing to do with that dollar is buy a bond, or buy stock, which is what Trump's trying to do with importing. You talk $6 trillion investment. That happens naturally through trade. This is the magic of what Adam Smith called the invisible hand in action. When people just look at prices and try to make a rational decision, automatically start getting efficient capital allocation. Kind of amazing. And that's what has happened over the last 30 to 40 years. If China burned the dollars we gave them, so we buy all this stuff from China, or let's say it moves to Vietnam, Mexico. We import Nike sneakers from Vietnam. Suppose they just burn them. So suppose you said, no, Ram, what if instead of buying back from the United States or buying investment assets, they just burn the dollars? Well, that lowers our inflation rate. Or what if Vietnam says, hey, we have nothing to buy from the United States. We're going to sell the dollars in the open market. Then the person buying those dollars must make one of those two decisions. They must either invest in the United States or buy merchandise or services. Those are the only things you can do. And, equilibrium requires that. The fact that it's a finite amount of money at that point in time changing hands requires that. There's no way. It's like physics. It's physics, people. That's the only outcome. So trade works. Hold China accountable. But there's no one getting ripped off. $5 billion. It's not happening. Show me who. You say, hey, Tim Cook, Tim Cook, the CEO of Apple, he ran supply chain operations for Steve Jobs. He is the guy. He knows the supply chain inside and out. You're saying, Steve, I know better. I know than every private actor. You've all made a bad decision. You don't know better. And this is when government says to people, we know better than you. I get nervous. I was at my kids' library this weekend, and we had a rainy day. It's fun going to the library, get your kids into that when they're young. Teach them critical thinking, because with AI, brains are going to turn into mush. There's no problem solving in the age of AI. I'm all for AI, but if you have kids, teach them critical thinking. So they have the book rack for sale book, Harry Potter's and all the rest. Then they have the books that they're just going to give away. It's as if it's infected with like bubonic plague or something. Okay. They've got like Russian borscht recipes. They have like some Danielle Steele novels, and they had this book, The Second Treatise of Government by John Locke. This guy, they should give an honorary signature spot on the Declaration of Independence, because he set up the principles of checks on government, separation of powers, and decentralization, pushing power to the edges, to the small and to the local, where people have information. This is what Friedrich Hayek talked about in Road to Serfdom in the 20th century. So yeah, anyway, we rescued this from the bookshelf. It's maybe spend some time with AI and give a look to John Locke. What else? Opinion on Shopify. I don't know. I'm not really focused on this kind of idea. It's not the thing I would naturally kind of look to, but clearly they're tariff exposed. Is that priced in or not? I don't know. How can you know? Can you know? Now, suppose you can't know. The question is is it sufficiently discounted so that you're compensated for the uncertainty of not knowing? It's like you're playing poker and before the river or before the flop, right? It's a difficult one and it's expensive. I don't know. I think there are better things out there. I think price free cash flow is 70 something. Look at ARM. Remember ARM, this IPO last year, the SoftBank IPO? Expensive stuff eventually goes down in price. Look at ARM, it's gone nowhere. Why not look at Taiwan Semiconductor? I mean, assuming we don't get tariffs tomorrow on these semiconductor chips, we'll find out. And assuming there's no China invasion, but those businesses are those are historically cheap. They've run up in the last 3 weeks. But mid-teens valuation with 20% revenue growth, where you're critical to all of your customers, that's a good business, right? I'm a Shopify seller. Yeah, and manufacturing in China. Well, right. I mean, Shopify is powered by Alibaba Express. Now, here's an interesting story. I met with this entrepreneur from China. He was born in mainland China, and he provides components to HVAC companies. I guess there's like 1,000 MBAs trying to roll up HVACs. Anyway, he supplies them some component. He manufactures in China. I asked him, what are you going to do with these tariffs? He said, oh, yeah, I got to move manufacturing. I said, where? Mexico? He said, no, United States. I said, wow, cool. Lennox is going to love your story. I said, how many jobs are you going to create? He said, 0. I said, what do you mean? He said, well, I need to hire someone, but I'm going to do advanced manufacturing. I said, oh, that's interesting. I said, where do you live? He says, oh, I live in the United States. I said, where do you pay taxes? He says, United States. I said, so these tariffs, you're not really part of the China system at all. He's like, no, I pay taxes, I have a green card. So it's a funny thing that's happening, right? So China's production comes from entrepreneurs, right? Those entrepreneurs have mobility. Well, China's trying to limit some of that, right? But they can move. So this golden visa idea, I love it. That's Lutnick's idea to sell a visa for X dollars, because one of the ways you can combat China is import the talent. That's it. You're taking the entrepreneurial know-how and the operational know-how with you and the customer list, right? It's not China that sells this stuff. It's businesses in China that sell stuff to Americans. It's Foxconn. Okay. Foxconn has operations in other parts of the world now, like Brazil. So take the talent, skim the talent. They certainly have a lot more STEM talent than we do here, right? They know how to invent an AI. China's ahead on battery technology. China's ahead on EV. They're ahead on nuclear. They're ahead on drone technology. Import all of that talent. That's how you contain and control China, among other things, right? So let's see, some question about the DAX in Europe. Well, this Europe trade I think it's kind of long in the tooth. Here's don't forget, these countries aren't growing at fast rates. I mean, let me show you the United Kingdom here. So that's the United Kingdom right there, and there are good businesses in there, like the banks especially. But it's the UK. It's had one hell of a rally. How about the valuation? How's that done? Well, it's on the higher end of the last few years. It's not, it's on the higher end of the last few years. Here they had some earnings declines due to recession. So I don't know if you can call that normalized earnings, right? But I don't know. I think the European trade is kind of long in the tooth. We haven't seen the fiscal spending yet. I mean, defense stocks, I guess, they're off to the races too, right? But I think that has kind of run quite a bit. You remember how Meta went up 20 days in a row in Jan or Feb, and then it, I think it's that. I think that's the stage you're in for Europe, and then it was a rug pull. Let's see. Palantir, that's, they reported, it looks like a double top to me. I'll call that out. These are, good stocks to look at because they are leaders in the market. I'm not saying own them, but get a sense of what's happening out there. That's a double top, right? It dropped 10% on earnings just on valuation. It was just ridiculously overvalued. The funny thing about Palantir, it's not that people showed up and said, oh, I'm going to short the stock. It's that the people that owned it themselves said, this is worth too much. I'm going to sell it. The bulls became bears. That's what happens. You're in the foxhole with your comrades, and then your comrade changes sides. That's how markets work, actually. The bulls become bears and the bears become bulls. So, if the admin lands the plane with a sensible low tariff policy, then sentiment can improve pretty quickly. And you can get a performance chase because you have those conditions for that. So I think it's important not to be overly bearish. Don't be overly bullish. I think at 5,600, a lot of good news is priced in. I think at 5,000, the end of the world is priced in, and neither of those are really it. So, but anyway, I hope that was helpful. We covered a lot of ground. And again, if anyone's in New York next Tuesday, you're an accredited investor, shoot Mark at lumida.com, MARC at lumida.com, a note. We're having a breakfast and lunch. It's like 15, 18 people at a nice restaurant, myself and Oliver Wright from Olivian. And we're going to talk markets, AI, and we're going to have some fun there. Should be good. It's the first time we've done this, actually. It should be a lot of fun. I'm looking forward to it. All right. Be well, everyone. Enjoy the spring. Take care now. Make it a great week.